Welcome back to another episode of What Works Wednesday. I'm your host, Leland Gross, and today I want to talk about all things health savings accounts. So, HSAs. I want to talk about what it is, why it's important, how you qualify for it, and then how you use it to the best of its ability. Because HSAs truly are one of the most powerful investment account tools for both investing, taxes, life planning. They're incredibly powerful, and yet they're one of the most overlooked and underutilized tools I've come across in my practice. Very few people have an HSA, know about an HSA, or if they do have it, are not using it to its full potential. So that's what I want to talk about today. All right, so what is a health savings account? So a health savings account is often confused with a flex spending account, an FSA. See, FSAs were originally created back in the day to be offered through employers to help you get a tax deduction to pay for medical expenses. So at the beginning of the year, you say, I want to save $1,000 into my FSA. You get a tax break to put money into it. And then when you take the money out to spend on medical bills or prescription drugs or anything like that, you get it tax free. The problem with FSAs are it doesn't roll over year to year. So if you don't use it, you lose it, which means you have to really know what your medical expenses are going to be, or you're going to have to lowball them to make sure you're not just throwing money away by putting money into an FSA. Well, that's obviously problematic. And that's when the government created an HSA, a health savings account. You may have heard it as a healthcare IRA. That's another name for it. And how this account works is it's the only investment account in creation right now that offers 3 tax breaks on it. So when you put money in, you get a tax break. It is a tax deduction off your income, just like you would with a 401k or an IRA or any other pre-tax benefit. So that's your first tax break. Tax break now and this year to put money in. But it's invested and it grows tax deferred. You do not get taxed every year on the earnings. It just continues to grow. So that's the second one. And then third, when you get money out of the account for healthcare expenses, it's tax-free like a Roth IRA. So when it comes to retirement savings, you get to choose one or the other. You choose either an upfront tax break with pre-tax traditional 401k IRA, or you get a Roth tax break, which is, I don't get a tax break now, but the funds grow tax-free later. Well, with an HSA, you actually get both, plus you get the tax-deferred earnings in the middle, which is incredibly powerful. I cannot tell you how powerful this is. So that's why it's important, is it's the most tax efficient vehicle. You would never pay taxes on that money. And once you turn 65, so once you get to retirement age and you get to age 65, then it can also be treated as a regular IRA. So in retirement, if you don't use it for healthcare expenses, you can still access the money without a penalty. You just pay income tax because you got a tax break on the front end, just like a 401k or an IRA. So it's another way for high earning individuals who've maybe maxed out their retirement savings options can continue to save for retirement or can continue to get those tax breaks. But even in retirement, if it's for healthcare, which that's a huge planning issue for retirees, is health insurance, healthcare expenses, things like that, your HSA would be tax-free for that. So incredibly powerful. Now, how do you qualify? Because not anybody can just go set up an HSA. You have to have what's called a high deductible health plan, an HDHP. A lot of acronyms in the healthcare and financial services world. High deductible health plan allows you to have an HSA. So when open enrollment comes around, whether you're on the marketplace, whether you are an employee and it's offered through your work, you are given a few options. You're either given a PPO, EPO, which is basically a, low deductible health plan. So you pay more out of pocket every month for your premiums. But then when you need healthcare, you have a lower deductible, which means the insurance kicks in quicker. Or you have a high deductible health plan where you pay much less per month. Your premium is much lower, but you have a higher deductible, meaning the first, few $1,000s of medical bills are your responsibility. Health insurance doesn't kick in until you hit your deductible, and then it kicks in. So in order to put new money into an HSA, you have to have a high deductible health plan. Once you have a high deductible health plan, now you're off to the races. And there's only so much you can put into an HSA each year. In 2024, it's $4,150 if you're single, or $8,300, double that if you're married. So a really great strategy is if you don't have a ton of medical bills anticipated this year. If you're like, I go to my doctor for my checkup, maybe something here and there, I really don't utilize my health insurance. Great, you're healthy. One, that's wonderful. Two, now you can get on a high deductible health plan where you don't have to pay a big health insurance premium every month. It's lower. And then you can take the difference. So let's say the PPO premium is $500. And let's say the high deductible health plan premium is $150. So you have a $350 difference between those two. Well, you could get the high deductible health plan, pay the $150, and put that additional $350 that you would have paid on the other health insurance plan into your HSA. Now, that's going to get you probably close to at least the single person's contribution limit. And then you can put lump sums if you want in there. Some employers match that. But then should you need your health insurance, now we have a bucket saved for that. But if you don't need your health insurance, that bucket continues to grow and continues to grow. At which point down the line, now you have this massive bucket that's accumulated over the years. So should something catastrophic happen, should you need to use your health insurance and have these big medical bills, I've pre-saved a tax-free bucket of money to use for that. I've gotten the tax break to keep more money in my pocket, not tipping the IRS. And now I have this awesome bucket created to help pay for that. So that's one strategy, is basically saying, what's the difference in premium between the low deductible plan and the high deductible plan? Let's save the difference. Another thing to note about HSAs are, let's say in a year where you're going to have a lot of medical expenses, you switch and you go to the low deductible plan. Well, you can still use your HSA, you just can't save into it. So an example, my wife and I, when we knew we were having our first child, we knew we were going to have labor and delivery expenses, and that's not cheap. So we had been on a high deductible health plan, and we had been very healthy, so it wasn't a problem, had built up our HSA. And then in the year we knew we were going to have a kid, we switched into the low deductible plan. So again, we pay a little bit more out of pocket every month, but our health insurance covers more of our bills. And then in that year, when we got our portion of the bills, the piece we have to pay, we had the HSA. Paid for that. It was really wonderful. Didn't really hit us with much out-of-pocket expenses. And then the next year, well, we're not having a kid again. So let's go back to the high deductible health plan and keep saving into our HSA. So there's a lot of flexibility year over year with these tools. They're great tax benefits. There's a lot of strategy around them. And a way that you can maximize this, a way that I think people don't maximize it is, well, I would say there's two. One, people don't maximize it because they don't max it out. They don't realize how powerful this is, that it's just as powerful, if not more from a tax perspective, than your IRA 401k at times. Again, it's all dependent on the plan, but it really can be because of those three tax benefits. The second way people don't think about is with HSAs, you have the ability to reimburse yourself for past medical expenses with no statute of limitations. It's this wonderful loophole. You may call it a loophole. It's just the rule that allows you to say, hey, I have this HSA built up. I had medical bills 5 years ago. I'm actually going to take the money tax-free out of my HSA now to reimburse myself for those bills all those years ago. And you might say, cool, why would someone do that? And I don't recommend doing this for like your groceries or random one-off things. But let's say you are in a pinch and you need money. Let's say you're in an emergency situation or a hardship and you need more money than you had in your emergency fund. Well, if you have receipts from your medical bills from however long ago, you can submit those and get out that money tax-free. You don't have the medical bill right now. Right now, you got whatever other need you want for your money. But you can use your past medical bills to still access your HSA. So that's incredibly powerful as this account grows. I have lots of people who just pay their medical bills out of pocket. They don't use their HSA, so they can build their HSA up and they just keep their medical bills. So you're getting medical bills throughout the year. You pay them with your cash flow, your out-of-pocket expenses. You save those receipts, you save those bills. You allow the HSA to keep accumulating. And then down the line, should you need the money, you have the medical bills that you can submit in order to get a reimbursement tax-free from this bucket of money that has been growing all these years. That is a really, really powerful strategy. So again, HSAs, 3 tax breaks. Tax break going in, tax-deferred growth year over year, tax-free withdrawals when used for medical expenses. You can qualify for it if you are in a high deductible health plan, and ways to utilize this are maxing it out every year if you can, and letting it grow, not just swiping it for every little prescription, keeping your medical bill receipts, but letting your HSA grow so that later down the line, should you want the money, should you really need the money for something catastrophic, you can submit your receipts to get a bigger lump sum tax-free out of it. And should you never need your HSA, should you get to retirement age, now it's just an IRA. It's an additional IRA that you've been saving your whole life and is a tax-deferred bucket of money for you. So if you don't have an HSA, look into it. Look at your healthcare plans next time you're doing open enrollment. It's incredibly powerful. 10 out of 10 think you should have one. And if you need help, reach out. But remember to go forth, build the life you want, and prosper.